Here's a question. When the market falls, what is that one investment that could save you? Hi everyone and welcome to Invest Money 101, where we talk about all things related to investing, news, money matters, trading, crypto, stocks, and many others. We hope that by the end of the video, we can provide you with some knowledge to make well-informed decisions about your finances. Today we are going to talk about the book called Aftermath: 7 Secrets of Wealth Preservation in the Coming Chaos by James Rickards. James Rickards is an American lawyer, economist, and investment banker who has written several books on finance and economics. One of his latest books, Aftermath, focuses on the aftermath of the 2008 global financial crisis and the potential consequences of the next crisis. In this video, we will discuss the 5 key takeaway and lessons that we found to be of great importance that we can learn from his book. Let's begin. 1. The financial system is still fragile. James Rickards shares that the global financial system is still fragile and has cracks in its foundation. Despite the efforts of central banks to stabilize the system after the 2008 crisis, he stated that the underlying issues had not been resolved and warned that the next crisis could be even worse than the last one. The reason for this is that people are still making the same mistakes that caused the 2008 financial crisis. One of those mistakes is borrowing too much money to invest, which is called excessive leverage. Another mistake is relying too much on complicated financial tools to make money, called derivatives. Derivatives are tools that people use to bet on things, like stocks or gold in the financial world. They can help reduce risk or make more money. Before the 2008 financial crisis, many banks and businesses were using derivatives too much to make money. They borrowed a lot of money to make these bets, and when they lost, it hurt the whole financial system. 2. Central banks are unprepared. According to Rickards, central banks are unprepared for the next crisis. He argues that the policies implemented by central banks after the 2008 crisis, such as quantitative easing and low interest rates, have created new risks and vulnerabilities in the financial system. Quantitative easing is when the people in charge of money make more money and use it to buy things like government bonds to help the economy grow. But it can also make the prices of things go up, and that will cause the money's value to be worth much less. Low interest rates mean it's easier to borrow money. This can help the economy, but it can also make people and businesses take on too much debt, which is risky if they can't pay it back. Since the central banks have borrowed way too much money, they will find it hard or may not be able to pay it back should the economy get worse. 3. Lessons from the 2008 crisis. There are several lessons can be learned from the 2008 crisis. One of the most important lessons is to avoid excessive leverage, which is when investors borrow too much money to invest. Another lesson is not to repeal legislation that limits the use of derivatives, which are financial instruments used to speculate on the value of assets. Rickards believes that the bank's reliance on derivatives was one of the main causes of the 2008 crisis. 4. Shift of debt. Banks used to lend money to people, but after the last crisis, they didn't have enough money to lend anymore. So, the central banks started lending money to the banks instead. This means that the central banks are now the ones who have a lot of debt. If there's another crisis, who will help the central banks? According to Rickards, the central banks have about $3 to $4 trillion of debt, and it could go up to $5 or $6 trillion. This could form a weaker US dollar value. 5. Gold as a safe haven. When the next crisis happens, the price of gold will go up because people will want to invest in something safe and reliable. Gold is often seen as a safe haven because it has been valuable for a very long time and is not easily affected by things like inflation or economic problems. Rickards carefully warns people that they should be careful when investing in gold through things like gold futures, which are contracts to buy gold in the future. Gold options, which are agreements to buy or sell gold at a certain price. Gold ETFs, which are like stocks that track the price of gold. Or gold mining companies, which produce gold. Instead, he suggests that people invest in physical bullion, which is real gold that you can hold in your hand. But Rickards warns that it might be hard to find physical gold when the crisis happens, so people should try to get it ahead of time if they can. As a final point, the book is a great eye-opener, and the things of the past and their repercussions are still heavily felt today. It's important to be careful with our money and understand the risks when investing. As James Rickards said, the financial system is still fragile, and those mistakes made decades ago could cause another crisis. Central banks might not be ready for the next crisis. Avoid borrowing too much money or using complicated financial tools. We should also be careful about investing in gold. And, to prepare ourselves for the next crisis, we should invest in physical bullion, but be cautious. By being mindful of our money and careful with our calculated expenses, we could prevent and prepare for our own future financial problems. If you learned something valuable from our video, please leave a like and subscribe to our channel. Thanks for watching and happy investing.